How to start investing with £100 in the UK. There is a myth that investing is for people with money already, that you need thousands sitting spare before anyone will take you seriously. That was true once, it is not true now. Today, you can start with £100 and in some cases with a single pound. So let us walk through exactly how, step by step, with the actual numbers. First, the thing that changed. It used to be that shares came in whole units. If one share cost £300, you needed £300. Now, most platforms offer fractional shares, which means you can buy a slice. Your £100 gets spread across a whole basket of companies rather than sitting in cash waiting until you have enough. That single change is what opened the door. But before you invest a penny, 2 quick checks. Check 1. Do you have any expensive debt? Credit cards, overdrafts, anything charging you 20% or more, paying that off is a guaranteed return of 20%. No investment gives you a guaranteed 20%. Clear the expensive debt first. Check 2. Do you have a small cash buffer? Investing money you might need next month is how people get burned, because they are forced to sell at the worst possible moment. Even a few £100 in easy access savings changes that. Investing is money you are leaving alone for 5 years or more. Right, those are done. Now, step 1, choose your wrapper. A wrapper is just the type of account your investments sit inside, and it decides how you are taxed. For almost every beginner in Britain, the answer is a stocks and shares ISA. You can put up to £20,000 in per tax year, and everything that happens inside it is tax-free. No tax on the growth, no tax on the dividends, nothing to declare. It is the single easiest tax win available to a UK investor, and it costs you nothing to use.
Step 2. Choose your platform. And this is where beginners quietly lose money, so pay attention. Platforms charge a fee to hold your investments. On a big portfolio, a small percentage is fine. On £100, a flat fee is devastating. Take a platform charging £4 a month. That is £48 a year. On a £100 pot, that is 48% of your money gone in year 1. No investment on earth recovers from that. The same platform on a £5,000 pot charges under 1%. It is not a bad platform. It is just the wrong platform for your first £100. So when you're starting small, you want 0 platform fee and 0 dealing fee. In 2026, Which found the cheapest platforms for portfolios under £50,000 were Freetrade, Trading12 and InvestEngine, all of which charge no platform fee at all. Compare the fees yourself before you sign up and check the provider is authorized by the Financial Conduct Authority. That is a 30-second check on the FCA register and it protects you. Step 3. Choose what to actually buy. This is where people overthink it. You do not need to pick stocks. Picking individual companies with £100 is not investing, it is gambling with extra steps. What you want is a global index fund, or its exchange-traded cousin, a global ETF. One purchase and you own a slice of thousands of companies across dozens of countries. If one company collapses, you barely notice. That is diversification, and it is the closest thing to a free lunch in finance. Look for the ongoing charge, sometimes called the OCF. A global tracker typically costs around 0.2% a year. On £124, that is about £2.40. That is what good value looks like. Step 4. Automate it, then leave it alone. Set up a standing order the day after payday. Most platforms let you invest regularly for free. This does two things. It removes the decision, so you never have to feel brave enough to invest, and it means you buy automatically when markets are down, which is exactly when you should be buying and exactly when nobody feels like it.
So what does this actually build? Let us do the maths, honestly. £100 a month at a 7% average annual return. After 10 years, you have paid in £12,000 and you would have around £17,300. After 20 years, you have paid in £24,000 and you would have around £52,000. After 30 years, you have paid in £36,000 and you would have around £122,000. Read that again. 36,000 in, 122,000 out. £86,000 of that was not your money. It was time doing the work. Now, honesty matters. 7% is a long-run average, not a promise. Some years are up 20%, some years are down 20%. At a more cautious 5%, that same 30 years gives you about 83,000 instead. Both numbers are before inflation, and inflation will reduce what that money actually buys. The point is not the exact figure. The point is the shape of the curve. Finally, 3 mistakes to avoid. 1. Checking your balance every day. Your investment will fall. That is normal, and it is the price of the returns. Checking daily just makes you more likely to panic and sell. 2. Chasing whatever went up last year. Last year's winner is not next year's winner, and the people telling you otherwise on social media are usually selling something. 3. Waiting for the perfect moment. There is no perfect moment. Time in the market has historically beaten timing the market, and every month you wait is a month of compounding you never get back. That is it. Clear the expensive debt, keep a cash buffer, open a stocks and shares ISA on a low-fee platform, buy one global tracker, automated, and then get on with your life. Thank you for watching. If you found this helpful, please hit the like button, share this video with someone who needs to hear it, and subscribe for more. New videos every Tuesday and Friday. See you in the next one. Remember, this is education, not financial advice. Investments can fall as well as rise, and you may get back less than you put in. Always do your own research and consider speaking to a qualified FCA-authorized advisor before making financial decisions.